Like-kind exchanges are exchanges of qualified business property for similar business property. The property must be business or investment property other than inventory, and it must be used for the production of income. The property must be tangible and must be exchanged for the same kind of property. The property in exchange must be identified within 45 days of the transfer of the property and must be received within 180 days. Most like-kind exchanges in the U.S. are for real estate. One of my clients uses this provision every 2 or 3 years in order to trade real estate because he has moved to a new city or wants to trade up to a higher value property. This tax benefit has saved him tens of thousands of dollars in taxes each time he's used it. If money or other property is received in addition to the exchange property, it is called boot and is regarded as gain on the exchange for the person receiving the boot, but not, in most cases, for the person giving the boot. It is taxed immediately up to the value of the amount received. For example, if your client Lisa wishes to trade her rental condo in a nearby resort which has an appraised value of $250,000 for a different rental home in a rural area having an appraised value of $240,000, it's likely that the person trading the less expensive home will pay Lisa $10,000 to even the trade. This $10,000 is called boot and is taxable gain to Lisa. However, to the party giving the boot, the payment is not taxed, but is instead regarded as an increase to the basis of the property they are receiving. What are the tax advantages of a like-kind exchange? A like-kind exchange is an IRS provision that allows for temporarily bypassing normal capital gains taxes when properties are exchanged instead of bought and sold. This can be beneficial if the taxpayer's intent is merely to reinvest what otherwise would have been considered a gain. However, when exchanged property is later sold for a profit, capital gains taxes will ultimately apply. For example, imagine that your client planned to sell his property for $250,000, which had a basis of $150,000, resulting in a $100,000 gain if he were to sell the property outright. His intent was to take that money and invest it in a similarly priced property that he thought had a better return. If his tax rate were 28%, he would be paying $28,000 in taxes. His basis in the new property would be $250,000. If your client instead chose to exchange the two properties, he may be able to defer the tax payment altogether. His adjusted basis in the old property would carry over into the new property. If he were to later sell the new property, he would pay the taxes on the total gain, likely including the $28,000 he deferred in the like-kind exchange. Potentially, the like-kind exchange provides taxpayers significant benefits, such as deferring taxes, limiting or delaying some unfavorable recapture provisions, and freeing up money upon an exchange to acquire better replacement property. With that said, there are times when a like-kind exchange is not favorable, such as when the client wants to use a current gain to offset other limited losses on his tax return, or the transaction results in a loss and the client wants the deduction now. That cannot happen with an exchange under current tax regulations. It is important to distinguish between a sale and an exchange. A sale and a subsequent or simultaneous purchase of qualifying property do not qualify as an exchange. The two transactions must be dependent upon each other. The exchange can include multi-party transactions, but it cannot be a transfer for money, which is a sale. When a party wishes to use the like-kind exchange provisions, they are required to contract with a qualified intermediary that will act as a clearinghouse for all parties involved. This ensures that the transactions will be handled correctly and within the limited exchange period.